Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Guessing the direction of interest rates is no easier than any other tactical or market timing decision. We're recording today on February 2nd, and the yield on the benchmark 10-year Treasury note is just under 3.9%. That's about 100 basis points less than it was a few months ago, a precipitous drop that few would have predicted. Fed policy is uncertain, inflation has not been fully controlled, and fiscal deficits loom as a long-term risk that would push yields higher. And those factors favor an allocation to floating rate notes. And my guest today will help us explore this asset class, its opportunities, and its risks. Jake Lemle is a managing director and head of loan trading and capital markets and a portfolio manager at Morgan Stanley Investment Management. So, Jake, let's start by having you tell me a little bit about your career path. Who is Eaton Vance? What is its relationship to Morgan Stanley? And what do you do there?
Yeah, thanks for having me. So, as you alluded to, Eaton Vance and Morgan Stanley have a new marriage. We were acquired by Morgan Stanley in 2021, and Eaton Vance is probably a familiar name to many of your listeners. But for those who don't know us, we're a global asset manager headquartered in Boston, Mass, and one of our key areas of expertise is in credit. So, really, we were a pioneer in managing high yield loans and bonds with some of our flagship funds sporting inception dates all the way back in the late 1980s. Today, Eaton Vance is one of the largest and most respected leveraged credit platforms on the planet. I really feel privileged to have spent my entire 17-year career here with the new, partnership and ownership under Morgan Stanley. It just feels like the opportunity set just got a whole lot bigger. So our franchise is truly a shining example of consistency and investment process over a very long period of time. And what do? I'm a senior portfolio manager on a range of different strategies, and I also run our trading and capital markets effort for the floating rate loan team. So I grew up trading, which really forged my skills in managing risk and in asset positioning and in portfolio construction. And what we at Eaton Vance specialize in is active fundamental credit management. And I've spent my career kind of helping build and grow this capability as the market has evolved and matured into what's now a $1.5 trillion asset class.
Well, let's talk about active fundamental credit management. Tell us about the opportunity in the asset classes that you focus on. Is this an attractive environment to be allocating to for senior loans?
Yeah, Bob, I really believe it is. It's not quite as good as it was, maybe a year ago, but I think the world is still massively underweight credit, and the yields are just impossible to ignore, right? The loan index put up 13+% return last year, with the vast majority of that coming through current income. So we were talking about equity-like returns delivered contractually, which are secured by the assets and cash flows of large, mainly U.S. companies that have enduring enterprise value and durable cash flows. Long story short, it was a good 15-year run, but now I believe we're in the early innings of a golden age for investors to make real equity-like returns in credit, and on a risk-adjusted basis, it's even better.
So you mentioned that the asset class returned 13% last year in 2023. What was the performance the year before that? And explain more what you attribute those results to, even though it was a fairly difficult period for bonds.
Yeah, sure has been. I don't know. I think there's a good opportunity maybe to step back in time a little bit to where we were a year ago, right? Coming into last year, 2023, stocks were in a brutal bear market. There was realistically nowhere to hide. Investor psyche was demoralized and fragile, and strategists across the street were calling for a hard landing or at least some type of recession, right? I even remember one one bank strategist had a negative 20% return expectation for the loan market. So they missed that one by 30+%. What did they get wrong? Well, there wasn't widespread distress among issuers. There wasn't pain across the entire economy the way many were predicting. Some sectors certainly had their struggles, as well as we've seen, our typical idiosyncratic credit problems that pop up along the way. But in the end, the loan market has been a major beneficiary of the Fed's rate hike regime, excuse me, and the inverted yield curve. So we've got 5.5%, 6% base rates plus a spread, and all in coupons in the 9, 10, 11% current pay range. So the reality is that the economy and corporate earnings have by and large surpassed very negative expectations. Our portfolios are built around durable cash flows from large companies that were able to manage through the supply chain shock and cost inflation. They were able to pass through prices, delay capital expenditures, manage their staffing levels in a tough labor market, essentially pull all the right levers as big, sophisticated companies are typically able to do, as they have the experience to do. So to me, it's really been a picture of resilience, and maybe even a pleasant surprise in some spots.
So you mentioned that you've done well in an environment of rate hikes and an inverted yield curve. Right now, the Fed seems to be poised to lower rates, although there's a lot of debate about how soon and how precipitous that decline will be. How are floating rates positioned given that environment?
Yeah, well, Jay just threw everyone a curveball on Wednesday and said no, that he's not planning to hike in March. But it's a fair question, and I think first off, we should probably admit that forecasting where rates are going is just gambling, right? Like the forward curve and the Fed dot plot. I mean, these things are wrong pretty much 100% of the time. When the Fed cuts, and we can probably say they will at some point, it will shave some of that coupon down. But we're starting with such a high relative yield advantage that I promise you, if and when yields come down to 8 or 9% on loans, I'll still be beating the same drum. Another thing to point out is that when the Fed does start cutting, for a lot of our issuers who will see their debt service costs decline again, and their business pick up as economic activity picks up across the board. But Bob, if you told me Jake, I'd rather just own a long duration fixed bond right now, the Fed's going to be cutting rates, I don't think that's at all irrational. Duration was not your friend for essentially 2 years, until the fourth quarter of last year when rates rallied so sharply. But I don't know, maybe that trade's over. Again, trying to predict where the 10-year Treasury is going to be is a fool's errand. And I'm not in the room on the Federal Reserve Board, but I would guess that they are keen to get the curve back to an upward sloping normalized term premium. So what that means for where rates are going to be is anyone's guess.
So you mentioned that you spent your entire career, 17 years at Eaton Vance, now at Morgan Stanley. I know that Eaton Vance has been investing in the loan asset class for a long time, and that you've developed a particular edge. You mentioned at the outset that your paradigm is active fundamental credit research. Tell me about what gives you and your team an edge in this asset class.
Yeah. So what do you get with us? In other words, plain and simple, we've got the expertise, we've got the process, we've got a huge, deeply experienced research team doing the fundamental credit analysis. Right. It's an intensive credit culture that's focused exclusively on the loan asset class. A lot of our other competitors have a centralized research function that different sectors tap into, right? And I believe our structure is a big competitive advantage over them. Everyone knows what team they're playing for. We've all been playing together for a long time, and the process really works. Credit investing is about knowing the names. It's about avoiding trouble. It's about living in the future, seeing around the corner and anticipating problems, be it at the issuer level or a broader sector call, because the analyst has seen the way the auto cycle has ebbed and flowed over a 25-year career. So we've got all the capabilities to also broaden the opportunity set in a lot of our strategies, using allocations to adjacent products, asset classes like high yield bonds and CLOs. Long story short, being active pays off in our market. It simply does not work. When you're buying an index fund in leveraged credit, you're indexing to the issuers that issue the most debt, which, I don't know, if you ask me, it's not a great strategy.
That's a topic we've written about fairly often at Advisor Perspectives. I know that your team has a new ETF coming out. The symbol is EVLN. It taps into the same team and the investment platform that underpins your long-standing mutual funds. Tell me more about EVLN.
We've had clients, Bob, asking us for an ETF for years and years. So we're just finally giving the people what they want. So it's the same team, same investment style, same discipline that investors know us for, just in a new wrapper. I'm super excited about the ticker is EVLN, EV loan, that's what it's short for. And when you scan the existing loan ETF landscape, the biggest loan ETF out there is a passive index fund, which underperforms the index throughout time. And the expense ratio on that fund is 67 basis points. They're not only expensive, but they're not doing any work. I think we just talked about how passive doesn't work in our market. And the key is that we at Eaton Vance are true loan market experts. And this is an active strategy that's going to highlight our best ideas.
Great. So, if there's one key takeaway that you'd like to leave with our audience of advisors about the diligence and the research they should perform before allocating to the loan asset class that you focus on, what would that be?
The yield is overwhelmingly exciting to me. It's not very long ago when our whole asset class was yielding 3 to 4, and the risks were quite similar, right? This is not a scary time to be investing in the loan market.
Well, thank you. And we'll include some additional resources in the notes that accompany this podcast. There'll be some links to learn more about EVLN and about Eaton Vance. There'll be a link to the Eaton Vance floating rate ETF page and a link to a page that has information about all of Eaton Vance's ETFs. Thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, and today featuring Jake Lemle of Morgan Stanley Investment Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service. Before investing, carefully consider the fund's investment objective, risks, charges, and expenses contained in the prospectus that is available at the Eaton Vance website. Read that information carefully.